holding the keys to a place that is finally truly yours. It's such a powerful image, isn't it? The classic dream of homeownership. But, what we found diving into the financial side is that this dream, it kind of comes with an optical illusion. The savings goal for almost everyone, it zooms right in on the down payment. And that intense focus just on that initial cash hurdle, well, our research shows it consistently blinds new buyers to all the other costs. We're talking about the many hidden costs, the ones that creep up before you even close, smack you with tax shock right after, and can, well, drain your budget for years, even decades.
Yeah, that's absolutely right. We're definitely going way beyond just that big upfront check today. Our mission here is really to explore these overlooked expenses, to give you a framework, to assess the true long-term cost of actually owning a home. The whole point is preparation, making sure that financial decision you make is genuinely sustainable for the long haul, not just getting you successfully to the closing table.
Okay, let's unpack this. Let's start right at the beginning. That moment you think, okay, I've got the money figured out. The myth is if you've got the down payment sorted, you're basically cleared for takeoff, financially speaking. But the sources we looked at are pretty insistent that the closing process itself is just, well, littered with financial landmines. What kind of costs hit the buyer before they even move the first box in?
Well, they often get hammered by closing costs they just didn't properly budget for. Specifically, we're seeing really significant spikes in appraisal fees right now.
The appraisal, right, that's to make sure the house is actually worth what the bank is lending.
Exactly. Confirms the value for the loan. But in today's really competitive markets, these fees have just ballooned, sometimes adding hundreds, maybe even thousands more to that final closing total than a buyer originally planned for. It's a real surprise for some. But the real complexity, I think, and where the dollars really stack up fast is with the lender fees. We're talking about a whole myriad of often overlooked charges. Application fees, underwriting fees, and especially loan origination points. These can really add up.
Loan origination points. Okay, that's definitely classic mortgage jargon. For listeners who haven't been through this maze, can you break that down? What are those points really? Are they like prepaid interest or is it something else?
That's a great question. Yeah, think of them mostly as prepaid interest. You pay it to the lender right at closing, and in return, you get a slightly lower interest rate over the life of the loan. So 1 point is simply 1% of your total loan amount. The underwriting fees, on the other hand, they cover the lender's cost of, checking your finances, assessing their risk, basically their admin costs for approving the loan. The really key takeaway here, based on our sources, is that you have to scrutinize that loan estimate document as soon as you get it.
Don't just glance at the total.
Exactly. Ask for a detailed breakdown of every single line item, because a lot of these mandatory charges might not be fully spelled out until you're just days from closing, and by then you have very little room to negotiate or even question them.
Okay, so you managed to jump that hurdle. The deal closes, the keys are in hand, the excitement's huge. Then, maybe a few months down the line, the first property tax bill arrives. And this introduces what our sources are calling post-purchase property tax shock. It sounds dramatic, but why is this such a consistently unexpected financial hit?
It's jarring mainly because most people, quite reasonably, look up what the previous owner was paying in taxes and they budget around that number.
Right, seems logical.
It does, but what they often don't realize is the whole mechanism of reassessment. Tax assessors frequently wait until a property sells, especially at a higher price point that's now verified by the market, to reset the baseline value for tax purposes. So that new higher assessment means your taxes get recalculated based on your purchase price, not the old owner's rate. This can lead to a bill that's significantly higher, sometimes shockingly so, than what you expected. And if you happen to be buying in a high-growth area, you can pretty much expect that trend to continue. Rapid increases in demand and property values mean your property taxes are likely to keep escalating pretty quickly over the long term, making whatever you budgeted for your monthly payment almost obsolete within just a couple of years.
Wow, okay. And this brings us to a really specific and potentially deeply consequential hidden tax that seems common in growing areas, especially places like California, Mello-Roos and similar special assessments. What exactly is a Mello-Roos tax, and why is it something that's apparently so easy to overlook when you're buying?
Right, Mello-Roos is essentially a special kind of tax. It was authorized by California legislation, and it's imposed on specific designated districts, often newer developments. Its purpose is actually pretty crucial. It funds the vital infrastructure and services these growing communities need. So think new schools, parks, maybe roads, police and fire services. Local governments issue bonds to pay for all this upfront, and then the homeowners living within that specific district. They're the ones responsible for paying back those bonds over time through this extra tax.
What's fascinating here is, well, it's the persistent, really long-term nature of these things. We're not talking about some small annual fee that vanishes after 5 years, are we?
Exactly. No, this is the part that buyers often miss or maybe don't fully grasp the implications of. These Mello-Roos obligations can add a really substantial amount. I mean, sometimes it's just a few $100s a year, but it can easily be several thousand, even over $5,000 annually in some cases. And the kicker is, they're designed to persist for a long time, usually 20 to 40 years.
40 years.
40 years, yeah. So you absolutely need to verify if the home you're considering sits inside one of these community facilities districts, or CFDs they're called, because buying there locks you into a significant non-negotiable financial commitment that massively impacts your total long-term housing cost picture.
20 to 40 years is practically a lifetime mortgage payment on top of the mortgage that really should be front and center in planning. Okay, let's shift gears a bit from these sort of fixed or at least predictable tax costs to the really unpredictable physical costs of just maintaining the building itself. Welcome, I guess, to what some call the never-ending money pit.
It's a very fitting title, unfortunately. When you rent, if the roof leaks, the landlord deals with it. When you own, that's on you. And those costs, they can be truly staggering. We looked at common unexpected expenses, and they often cluster around the big systems failing. An HVAC system failure, for instance, they can easily run you anywhere from, say, $5,000 to $15,000 to replace, depending on the house size and the system type.
What?
Yeah. Or a major plumbing line repair, maybe needing to replace the main sewer line. That can be equally financially disastrous. To try and manage this, our sources kept pointing to a critical rule of thumb that, honestly, too few homeowners seem to follow. It's the 1% to 3% rule.
Okay, what's that?
So many financial planners recommend budgeting about 1% to 3% of the home's total value every single year, just for maintenance and eventual repairs. So if you buy, say, a $400,000 house, you should ideally be setting aside somewhere between $4,000 and $12,000 a year, minimum, just for upkeep and future big-ticket items.
That figure alone completely changes the affordability calculation for a lot of people, I'd imagine. And beyond those huge catastrophic costs, you still have all the ongoing sort of preventative maintenance stuff that people just constantly seem to overlook.
That's absolutely right. We often forget the cumulative costs of just the routine services. Getting the gutters cleaned every year, maybe a pest control contract, lawn care if you have a yard, seasonal tune-ups for the furnace or AC. If you skip these smaller ongoing costs, you're really just inviting the much larger, much more expensive failures down the road, ignoring, say, water damage from gutters that are clogged. That can lead directly to needing that $15,000 roof replacement we just talked about. It's penny wise, pound foolish, really.
And speaking of ongoing costs, let's touch on utilities. I remember hearing an anecdote once about someone who bought an older house and then realized their first winter gas bill was actually higher than their expected mortgage payment just because the insulation was terrible. How real is that kind of utility shock?
Oh, that anecdote is far, far too common, especially in homes built before, say, 1980 or so. Utility costs can easily be 30% higher, maybe even more than what you might have projected.
Yeah.
It's often due to just aging infrastructure, leaky windows, drafty doors, poor insulation in the walls and attic. And the tough part is, to cut down on those really high bills, the homeowner often faces a pretty big immediate investment. You might need to spend $5,000, maybe $10,000 or more on things like adding insulation, getting new energy-efficient windows, or upgrading old appliances just to make the house financially bearable month to month.
Okay, now let's talk about some of the external pressures that can inflate your costs.
Yeah.
Things you have maybe very little direct control over, like insurance premiums and community fees. These feel like unseen escalators just quietly pushing up the budget. Why are homeowners' insurance costs, in particular, rising so dramatically across the board?
Yeah, there are really two main drivers, and they're kind of intertwined. The first one, undeniably, is climate change. We're just seeing more frequent and much more severe weather events, like wildfires, major floods, powerful storms. This leads to a huge surge in insurance claims.
Makes sense.
So insurance companies, naturally, are trying to mitigate their risk. And they're doing that by dramatically increasing premiums, sometimes even pulling out of certain high-risk areas altogether, but even raising rates in places previously thought of as low risk. The second driver is just plain old inflation. The cost of materials, like lumber, roofing, siding, and the cost of labor to actually do repairs have skyrocketed.
Right. Rebuilding costs more.
Exactly. So your coverage amount, what it would actually cost to rebuild your home if it were destroyed, has to increase just to keep pace. This means you need to regularly review your policy limits and likely increase them, which of course makes that annual premium payment creep up steadily year after year.
And depending on where you live, you might not just need the standard homeowner's policy, right? There could be extras.
Precisely. Yeah, if you're buying near a coastline or in an area known for earthquakes, you might find that supplementary policies like specific flood insurance or earthquake insurance are either mandatory by your lender or at least highly advisable for your own protection. And these specialized policies, they layer substantial additional costs onto your annual budget. Sometimes they can almost double your total insurance expense, making it a really serious financial factor you just cannot ignore in your planning.
Okay, and layering on top of that potentially are the community costs, specifically if you buy into a place that has a homeowners association or an HOA. You hear a lot about these fees, and they aren't static, are they? They seem to be growing quite fast in many areas.
Yeah, HOA fees are definitely not fixed. They're designed to cover the costs of shared maintenance, maybe landscaping, snow removal, upkeep of common areas, but they're absolutely subject to constant fluctuation. The costs for maintaining those community amenities, the pool, the clubhouse, the shared parks or gyms, those costs go up and they get passed directly onto the homeowners through the fees. But the real hidden danger here often lies in special assessment.
Ah, yes, the surprise bill.
Exactly. If the community needs a major unexpected repair that wasn't in regular budget, maybe replacing the roof on the community center, or resurfacing all the neighborhood roads, the HOA board can vote to levy a one-time special assessment on every homeowner. And that could suddenly mean you have to write a mandatory check for, say, $3,000 or $5,000, often with very little warning. Ouch.
Definitely ouch. Okay, finally, as we start to wrap this up, we should probably address a cost that's maybe less tangible, but our sources indicated it's very real and derails budgets all the time. Lifestyle creep. The money pit isn't always just physical repairs, it can be psychological too.
It absolutely is. That psychological cost often comes right from the excitement of having this new space. You close on the home, you get the keys, and suddenly there's this powerful urge to upgrade everything, furnish it perfectly, maybe start renovations immediately.
The nesting instinct on steroids?
Kind of, yeah. It's this post-purchase high that leads to impulse, buys new furniture you didn't budget for, fancy new gadgets for the kitchen, maybe deciding to paint every room right away. And this can quickly spiral into unexpected debt, often on high-interest credit cards, right after you've taken on the massive debt of the mortgage itself. So it's really critical. Our sources advise that buyers try to maintain that strict budget discipline they likely had while saving up for the down payment. Resist that powerful temptation to overspend on making the house perfect right out of the gate. Pace yourself.
Okay, so we've really mapped out quite a landscape of potential costs today. We've gone from those hidden fees that can bite you even before closing, to the decade-long financial commitments like Mello-Roos, the unpredictable pit of major home maintenance and repairs, the potential shock of high utility bills, and the steadily escalating prices for insurance and HOA fees, not to mention that lifestyle creep. So, what does this all mean?
Well, I think it primarily means that while homeownership absolutely remains a phenomenal financial tool for wealth building and a huge personal reward for many, the successful homeowner is almost always the educated one. Preparation and just basic awareness of this full, sometimes complex spectrum of expenses are just critical. Being informed about every potential cost, not just focusing solely on that down payment number, that's really the key to avoiding major financial stress and ensuring your homeownership journey is successful and sustainable long term. And maybe a final thought to leave listeners with. Since sellers are, in many places, legally required to disclose things like Mello-Roos obligations, and lenders must provide those detailed loan estimates we talked about, what specific detailed document reviews should you, as a buyer, prioritize to try and avoid the absolute largest, potentially multi-decade financial surprises? You really need to know exactly what you're signing up for, long before you fall completely in love with that charming front porch.